Welcome to VIB Today, the daily podcast from the Newsroom of Business in Vancouver. I'm Kirk LaPointe, publisher and editor-in-chief. These are certainly uncertain times in managing funds and planning finances, whether it's inflation, interest rates, market convulsions, supply chain problems, war, among other things. We're making decision-making so much more difficult for people. Our discussion today is going to explore these issues from two perspectives: how to invest and how to plan your funds. My guests are two leaders from these sectors. Claudio Chisani is a portfolio manager and investment advisor with BlueShore Wealth, and Woody Yang is a financial advisor and certified planner with BlueShore Financial. And we're going to explore their perspectives on conditions and prescriptions for investment. It makes sense to start with a bit of a start of the status of the situation. And I thought, Woody, take us into what the economic situation is for your role in this, and what you're talking to your clients about in terms of the challenges that are out there right now and trying to make their own decisions.
Absolutely. Thank you for having me here. So three major things I noticed when I deal with clients daily. The first one recently would be definitely high inflation period. It's a higher cost of living. We all noticed it on like rents, gas, daily goods such as groceries or food or even our morning coffee. We all feel the pinch. And the second thing I noticed is the higher interest rate has a great impact on people's debt, especially on variable rate mortgages, line of credit, certain consumer loans. From April till now, most of the variable rate debt has almost doubled. So which means people have to allocate more cash flow into the debt payment to match the increased interest rate. The third thing I noticed is for people who have established a great financial habits and routinely budget and have established a financial plan, they notice that all of a sudden they have to change their financial plan. They will have to reevaluate during this situation because they will need to distribute income differently. For example, they need to cut certain expenses and save less, maybe. And for people who doesn't have a habit of budgeting or clear financial goals, I noticed that they might feel a little bit lost in this time period. They don't know what to do anymore. So those are the three major things that I noticed.
Sure. And Claudio, Woody explains a little bit about, once you've got that money, how you're planning for it. But I mean, how do you invest in this kind of climate right now with all of these uncertainties? And walk me through what kinds of things you're having to navigate with your clients.
Well, Kirk, to resonate Woody's point, this has been the largest interest rate increase in 15 years. We have gone from 0 to 4% on the scale of rate estimated by the end of the year. If the Bank of Canada and the Fed would promise and fulfill on their promise of bringing rates up. So in this environment, it is a little bit more challenging. We have seen for the first time statements that are down in value since the peak of 2021 in November. So I think it is really important to reevaluate your investment portfolio. It is important to be prepared to accept volatility and expect that inflation will have an impact on financial assets as well as fixed assets such as real estate and financial markets. Now, it's not all gloom and doom. We have to focus on the positives in this environment. And I think for the future, financial companies with good balance sheets and excellent earnings will command a premium. So future investments in such companies would, on a long-term basis, would be fruitful. At the same time, the bond market, it's producing 4% and 5% yields on a short term. Therefore, investors would be able to generate rates of returns in the fixed income area that they have not been able to in the past. And to Woody's point, look at our GIC rates on a one-year basis, Woody, right? It's certainly looking a lot better out there.
Yeah, exactly.
And what are some of the common mistakes people make in an uncertain climate like this? Is it Woody? Is it panic? Is it pulling money out? Is it is it deferring deferring plans? I mean, where are you finding people moving right now?
From financial planning perspective, one of the biggest common mistakes I've seen these days is people choose to not to act, choose to stay put until the condition has changed or they feel more comfortable in this environment. I noticed some clients felt like overwhelmed or fearful in this environment, choose not to deal with the situation seems like an easier way for them to cope. Another one could be they were influenced by certain fear-based news and start to panic. They let emotions take the lead and forgot the strategies that were already set to help them to achieve their long-term financial goals. Like they might want to change their financial plan or investment strategy drastically just because they're fearful of the market. So I believe Claudio can speak a lot to that as well.
Yeah, but I want to stay with you for a second, Woody. Is it that people don't trust what it is that they sat down originally and scoped out as a long-term plan, and they decide that maybe they need to abandon the long plan here? Is that it?
I love this question because I do ask a client when I review financial plan with them. Most of the time I notice that it's because of their emotion. It's because they've heard so much negative news and that influenced how they think or how they evaluate their original goal. It blurred their vision. That's how I see. But after we sit down, we review everything, they start to get a clear picture. Oh yes, I still have the same goals. My cash flow is still doing the same thing. Yes, investment environment might be different, but we are looking at the long term. We have 20, 30 years time till when I need the funds. So nothing really has changed. And all the investment strategies that's already in place, they are quite solid. So it's just that emotion that caused the panic, I think.
Yeah, Claudio, you're obviously with investors. Also trying to look for the smartest moves in uncertain times, and it often does mean making moves, doesn't it?
Yeah, well, it certainly does. To resonate Woody's point, congratulations for being human, I would say to all investors out there. I mean, if you decide to move to cash as you see your portfolio moving in value, to us, that's a little bit of an overreaction. If you decide to stay the course without analyzing your investment portfolio for what's in store for us for the next 5 or 10 years, well, that could also be a little bit detrimental. So underreacting or overreacting are things that you do not want to do during challenging times. And who knows what the next decade will bring us in terms of returns. But I think from a financial and investment planning perspective, being proactive wins the race. There are so many things we can do with clients' investment portfolios in this environment. We can design new cash flow strategies. We can talk to their professionals and accountants and lawyers and find out if there is a way to maneuver from a tax perspective since assets have repriced. We can look at repurposing some of the RSPs and stress test their liquidity as well as their risk tolerance. Run a scenario where maybe markets would still go down 10, 15% and see what their comfort level is at. So there's a lot of proactive work we can do right now today to position ourselves for the next 5 to 10 years.
Now, I'll stay with you on this one, Claudio. I wonder, the pandemic, of course, we haven't even talked about, and it certainly was one of these things that disrupted a lot of the economy. As the pandemic, do you think reset what expectations might be now in the way that investment yields? Is there any kind of true pandemic effect you can see now?
I think that's a really interesting question. Very much like the chicken and the egg. I mean, at the end of the day, has the market reset expectation? Has the Fed pivoted or not? The thing that I will always go back to is the fact that since 2010 to 2022, we had a decade of 600% return on the S&P 500. So the American market has generated 600% in terms of gross return since 2010. So now In contrast, if you look at 2000 to 2009, now that's a decade of minus 50% return. So if you look at it as a first and a second inning in a game, now I could certainly say that that the pandemic has brought quantitative easing that has been unprecedented. But what came with that is interest rates moves from 0 to almost 4% soon that are also unprecedented. And I think the expectation for return has to be brought back in line to historical norms, and historical norms are 6 to 8%. If we are used to 20% return over the last decade, that's certainly not the status quo for financial markets, and at some point all things will come back to a mean. So I certainly expect maybe lower returns moving forward, but I'm not completely disappointed or checking out on the financial markets and capitulating. I think this is the time to buy quality, invest in dividend payers, but expect the capital appreciation may be challenged for the foreseeable future.
Yeah, and Woody, it's apparent too that we need to put behind us this era of nearly free money in borrowing, and therefore we have to think through a little bit differently about how it is that we're doing financial planning, particularly if there's any work that's being done or on the borrowing side in terms of mortgages or whatever. What kinds of resetting do you think the pandemic has applied in terms of that financial planning, though, for your clients?
So I definitely completely agree with Claudio. The last 2 years, investment returns were inflated by the unique measure of the pandemic. All the government's monetary policy and different stimulus programs has really promoted the assets value and the economic performance. And the cheap debt, like low interest rate, encourages all the business and individuals to spend and borrow. As a planner, I do trust setting the expectation based on long-term historical data. Like Claudio mentioned, if we're looking at 2 different decades, we can have different expectations. But if we really use long-term historical data, like 20, 30 years of average return or average mortgage rate, for example, if we are talking about that, that will be more accurate when we use that into financial planning. And in today's environment, also, Claudio mentioned the stress test your financial plan. So we do encourage clients to stress test their financial plan by lower expectation of the investment return, and also perhaps increase a little bit of the expectation to inflation to give them a little bit buffer for the future projection.
We all, I think, watch these podcasts with also a bit of a design in mind, which is to try to understand, get that kind of last bit of advice. On the basis of the discussion we've had today, I wonder if you could give us each a bit of a 2 or 3 point checklist and around your investment and your planning. And Claudio, I'll start with you about what's the stress test or the health check or the reality check that you want to provide clients in order that they leave your office feeling better and not worse, for instance.
Well, all my clients leave the office feeling better, I have to tell you that much. But certainly, the one thing that I would emphasize is it's being proactive. When you have that meeting, rather than having it in isolation with one individual, coming in with your financial planner and investment advisor and setting parameters as to what you would like to accomplish for the next couple of years. So let's deal with the short term, and then let's look in the future, 10 to 15 years, stress testing your liquidity. If you are in an investment portfolio geared for retirement, do I have enough liquidity to take on the next couple of years, acknowledging that those years may be a little bit more challenging? In case of a cash flow type portfolio where the investment portfolio drives your income needs, do I have that 4 or 5% yield available to me and reoccurring on a quarterly basis where my income is not jeopardized moving into the future? And certainly, has my investment plan operated by itself, or is this in a concept of harmony with my tax planner and my financial planner and all other professionals, where we can take advantage of a group effort where that decision is not emotional and not made in isolation. So be proactive, work with your COIs, reset your expectations to slightly lower returns, but at the same time, look at the bond market, look at alternative investments, look at tax efficiencies. There's so much good work that can be done. And I think that's the moral of the story.
Sure. And Woody, when you're looking at the longer range and what it is that you want to do in terms of planning, walk me through again what you think are the checklists, the important milestones that exist in all of this in order that you have a portfolio and a plan that actually has some coherence to it.
The very first one I would say is have a budget. No matter where the life stage you are, spend some time to build a detailed budget, because that will give you a realistic picture of where you are and what's your current financial situation. And the second one I would say is write down your top 3 financial goals. Have those financial goals in mind and tell yourself what you're willing to do to achieve those. The third one is to build your team, work with the trusted advisors to build a financial plan, the roadmap to achieve those goals. And I do have one bonus tip, which is have a healthy mindset. Understand that achieving those long-term goals will call for like short-term sacrifice, perhaps. And there will be turbulent times like today's environment during this process. So have a healthy mindset and understand the process and stay true to your financial goal. That would be my checklist.
Okay. Well, then I'll throw a bonus question here at both of you as we end off, because I think it's actually very good. We've talked a lot about emotion in all of this and its role in it. And I thought maybe we could conclude by talking about worrying. Right? I mean, we talked at the start about uncertainty and how that might affect your investment strategy, your financial planning, all of that. As we conclude, maybe a little bit of advice that you give people when they come in to see you about worrying. What do you tell them, Woody, to deal with when they start to express worry?
I love this, and I love this today especially because we are in this fall season. And if we're looking at 4 seasons, fall is the season that all the leaves falling off the trees is a season of change. And it is a very normal part of every year, and it's a part of the life cycle. So when we're looking at investment environment, when we're looking at financial planning, and when we're looking at our life, we do go through different cycles. So when clients feel worried, I think it's great to remind us this is a season of change. We all experience unexpected situation in our life, and spring will come, summer will come at the end. So keep focused on the positive side and keep focused on the vision of your life, of the financial plan goals.
That's very nice. That's good. Great answer. Claudio, what's your prescription for people who come in with a pile of worry?
Well, I mean, Woody has put that very eloquently, and I have to resonate the same thoughts that pertain to an investment portfolio or the value of your other assets. At the end of the day, worrying is natural, and there's 2 types of worrying. I mean, if we worry and we take no action, perhaps that creates even more anxiety. If we worry about something specifically that can be addressed, then let's address it today. It is and accept the fact that this is one chapter in the book of investing and planning and financial markets. And you know what? At the end of the day, we have to reframe the reason for worrying. Are we worrying about 4% interest rates? Are we worrying about the economy being able to take that? Are we worrying about what 4% would pertain to us in terms of our financial household and financial well-being? I would say that where we are today, to a certain degree, we're moving towards a normal scale of interest rates. And of course, yes, we went from 0 to 4%, but 0 to 4% soon, now we're 3.25%. Now, it doesn't necessarily mean that we're going from 4 to 8. So there are boundaries here. And at the end of the day, we'll all end up better off out of this, just like we did a couple of years ago. Now we have We have the fixed market, the short-term bond market giving us returns. Perhaps we'll have a healthier financial environment, and we'll get through this together. And the key message here is, don't worry by yourself, worry together with us, and we'll be able to take that away as much as we can. And the future is always sorting itself out.
Okay, well, I feel better now. Thanks very much, both of you, Claudio and Woody, for your advice today. Hope people value it and act upon it. Good to talk to you both. Thanks for your time.
Thank you very much, Kirk.
Yeah.
Our pleasure.
I'm Kirk DePoint, publisher and editor-in-chief at BIB. Thanks a lot for watching.